I have got a stock I'm sort of looking at buying in the new ISA year. It might be immediately, it might not be, but it's not a million miles from your one, Steve. It does a bunch of things, including some food packaging stuff. So if you've ever had a takeaway in one of those cardboard boxes that fold up, it probably came from these guys or came via these guys. This company is out of your kind of playbook, I guess, in that I'm not entirely sure how you pronounce its name. It is also listed in the FTSE 100, though. It's a company called Bunzl, and that's what I'll be calling it for the next 10 minutes or so while we talk about this stock. What does Bunzl do? Well, Bunzl is a distributor, and it's out of the same mould, since I like comparing it to things that I already know and have talked a little bit about, as Diploma, which is a FTSE 250 stock that I like. In other words, it's a distributor of things. It's not a manufacturer. What it does is you buy your stuff from them, and they provide value by sourcing and providing customer expertise and so on and so forth. We'll come back to that in a moment. But what Bunzl distributes is consumables, and they distribute reusable carrier bags, PPE equipment, hygiene stuff, food packaging, all of these kind of nice things. And they have about 150 smallish businesses that they've either acquired or grown or built or so on. So as a distributor then, what are you looking for from that? Well, there's one obvious burning question, I guess, when you think about distributors, which is what happens when Amazon starts doing this damn thing? Because Amazon could pretty easily, I think, start distributing or acting as a distributor for food packaging stuff. They probably do, and grocery packaging stuff and PPE and hygiene and all the other stuff that I meant. Well, if you're a distributor, either like Diploma, to be honest, or like Bunzl, you need to find some way of adding value rather than just being a kind of shop. And the way they do it in the case of competing with something like Amazon is by having local specialist teams, and they work very closely with their suppliers and their sourcing and their product knowledge is what they kind of offer you here that you won't get on somewhere like Amazon. You can probably find stuff on Amazon, but you'll need to know what you're looking for, and you'll need to have an idea of how it all kind of works and fits together and of everything that you need. So if you're running an event of a sort and you want to have some sort of catering thing there, Bunzl will have people who can tell you everything that you need and be able to ship it to you in one nice handy package. With the exception of something like Amazon, everything else here competition-wise is much smaller. It's all kind of very localized, very specific things. They have, therefore, over most of their competition, a big advantage in terms of scale and a big advantage in terms of being a kind of all-in-one service. They can source things from all around the world rather than small kind of family-run businesses that source from kind of locally, which is a good thing for a number of people, but it can be more expensive, and Bunzl scale gives it a much more reliable and much more cheap, basically, service here. So let's talk some numbers then. Let's start with the numbers that I kind of like when I think about stocks. If you're a distributor, what you don't want to be seeing, or what's supposed to be a big advantage, is you don't have massive fixed costs and fixed equipment and that sort of thing. And they don't. They generate around 757 million is what I've written down. It's a touch more than that in operating income. And they do it using 667 million of property, plant and equipment. That's after depreciation. But when that first number, the operating income number, is higher than the fixed assets number, I generally think this is a kind of decent cash generating business. Another way of looking at that same thought is through the cash flow statement. So 95% of their operating cash flow becomes free cash flow. So CapEx requirements are pretty light here. Revenue's been working its way higher. They're on a 6% CAGR, and they have kind of growth avenues that are a combination of inorganic things and acquisitions. They're a highly acquisitive business as well. Earnings per share has been slightly more growthy than that. It's around 8%, and their debt, unlike Middleby, I think here, doesn't look much like it's an issue to me. They currently send out about 11% of their operating income on paying interest expense, which is basically interest on their debt. This does pay a dividend. It pays a dividend of 2% something or other, which is the kind of dividend that doesn't kind of scream out at you. But I think this is a stock that's pretty well run, and it's the kind of business I quite like here. When I look at the market cap, which is sort of 10 and a bit billion, they're trading at around a 21% price earnings ratio. And they've recently had a deal with Walmart that came in February. Their stock pushed higher as a result, which is what's caused this to get into PEs above the that begins with a 2 rather than begins with a 1. Walmart, of course, huge distribution channels, and if you can distribute through those, then that's very helpful. So Bunzl sending out grocery packaging, road cones, and that kind of thing. I say that kind of thing. Those are in no way similar to each other, those objects, but they are all distributed through Bunzl. That's been pushing stuff higher. Their Walmart deal. They're another food-based stuff, but rather than distributing food manufacturing equipment in the style of Middleby, what they distribute is basically consumables. So their moat is kind of, I mean, it's clearly not the same as a Middleby thing. Middleby's is to do with switching costs. Bunzl has relatively low switching costs. What it wants to do is get this stuff to you cheaper in terms of scale and use its advantages there. I like this stock very much. I would like to see a slightly better capital return thing to shareholders. In other words, I'd really like it to buy back its own stock. I really like it when companies buy back their own stock, and I'm increasingly softening up to the idea of I don't need the thing to be trading at a screaming discount for that to happen, because I actually think that's harder than I used to think it was. If you're waiting for your stock to trade at half its book value before you buy back your shares, you might be waiting ages, especially if your cash keeps piling up. It's very unlikely that even retail investors are going to let you sit there with 28 billion in cash and let your market cap go to 3, because they will just see that and think it's not going to go that low. It can't get below that kind of thing. So I'd like to see a better capital returns thing here. A 2-something dividend is the kind of thing that I would probably try and dangle in front of Paul, and when he says no and goes and buys more AT&T, start pushing it at him a bit more ferociously. But Bunzl, that's a stock that I like. It's one that has been on my list to look at for quite a while, and having looked at it, I like it very much. Their website also says lots of helpful things, which I find useful in doing research here.
Yeah, I've just been navigating this while you've been talking, Steve. I've had a really good look around Bunzl's website. There's a lot of interesting stuff in there. In fact, this is like, if you understand Diploma, you will understand Bunzl. They are very, very similar kinds of business.
Yeah,
Interesting,
so.
Steve, that we've both picked companies with exactly 2.7 billion in debt. Bunzl have 1.5 billion in cash flow, whereas Middleby only have about 140 million, I think, off the top of my head. Might be a little bit more. It might be 170 million. Yeah, really interesting, Steve. I was just looking down all the ownership breakdown as well. Institutional ownership at Middleby is 90%. Institutional ownership at Bunzl is 89.8%. So it's almost like we've like different companies under different. Am I on the same screen? Yeah, really, really interesting looking down this, Steve. This looks like a perfectly fine company. It's still growing at about, its compound average growth rate is about 9%. 4.4 billion in acquisitions over the last 17 years. That sounds very Diploma-like. There's a lot of little companies in there that they've bolted on. And I quite like the idea of, rather than trying to be this massive company that competes with Amazon, trying to be more nimble than Amazon. That's a strategy that's definitely worked for Diploma. I don't see why it wouldn't work for Bunzl either. Yeah, I like it a lot. I guess my only sort of interesting point is I actually pulled it up on Simply Wall Street to see what they thought, and I was scrolling down it as you were telling me. This is the first company I've ever seen on Simply Wall Street where they don't think it should be worth 14 times what it actually is priced at today.
Yeah, valuation is kind of tricky. I mean, it's a lower PE than Diploma, but I think it's probably a slightly worse stock than Diploma, or a slightly worse business than Diploma, mostly because Diploma is smaller and has better acquisition opportunities. I'm kind of interested in why Middleby has such high institutional ownership. It's not... What's it listed? Is it part of any kind of index? I mean, Bunzl's FTSE 100, I assume it's a part, therefore, of every FTSE 100 ETF you've ever heard of. And since it's not one of the most famous companies in there, I guess not many other people are busy owning it. But is Middleby's not S&P 500, is it?
I wouldn't imagine so. It's not big enough, is it? It's only
no, it doesn't sound big enough, and it seems like, yeah, until recently it would violate the profitability criterion as well. But I'm interested. That's heavily kind of institution owned as well.
Yeah. The only issue, I guess, is that they're probably having Vanguard and BlackRock in this, who have about 9.4 and 8.5% of the company. But just looking down the list of institutions, it's just equity groups, really. It's Select Equity Group, Wellington Management, which I think isn't that a part of Vanguard, 7.61%. And there's Victory Capital Management, T. Rowe Price, JP Asset Management, and Brookfield of all the companies as well. So these companies don't have massive stakes in terms of what they tend to have in some of the big companies. Like Vanguard is the biggest owner with about 723 million. But that's 10% of the company. So it is strange to see something that is this small to be, to have this many of the big asset managers all sniffing around it.
Yeah, interesting that we've both gone for food stocks. Not an accident exactly, or for kind of food production and catering related, I guess. Stocks you would more likely call them, rather than sort of food producers themselves. It's not entirely an accident in the sense that I knew you were talking about Middlebury and thought I'd chuck Bunzl in that I've been looking at recently. But it's a really interesting kind of way to kind of think about different areas of this and different ways in which that kind of, I guess the expression is value chain, although I'm not sure I think of it. I like that expression. That's the official term for it. The way all that kind of fits together in different ways.